Michael Burry just shorted $1.1 billion. Yes, the same guy who predicted the 2008 housing collapse, the one who made billions when the world thought he'd lost his mind, is betting big again. This time, he's not targeting real estate or banks. He's betting against the heart of the current market obsession, artificial intelligence. And one of those names is NVIDIA. Why? Is this just another one of his crazy early calls, or the first sign that the biggest tech story of our time is running out of road? Because here's the thing. Burry doesn't make random bets. Every move he makes is a warning wrapped in numbers. And if history is any guide, the market should probably listen. In this video, I am diving straight into his latest 13F filing to decode exactly where that $1.1 billion short is aimed, what he's buying on the side, and what it all says about the next big turn in the market. You know, the thing about Michael Burry is that he's not loud. He doesn't chase interviews or tweet every day. He just studies numbers until he finds something that doesn't make sense. Then he bets everything on it. That's exactly how he spotted the housing collapse back in 2008. Everyone thought home prices could only rise, and banks were handing out loans like candy. Burry dug through the fine print, realized the math didn't add up, and took the other side. The world laughed, until they didn't. That moment made him legendary. Since then, he's kept that same contrarian reflex. He looks for euphoria, for places where optimism gets reckless. During the meme stock craze of 2021, he warned that it would end badly. When everyone was buying crypto at record highs, he said the market was drunk on cheap money. And now, as artificial intelligence becomes the new religion of Wall Street, Burry's stepping into the same familiar role, the skeptic in the corner who's willing to look foolish while the party's still raging. He doesn't see himself as a genius or a guru. He sees himself as a data guy who hates hype. Every big win he's had started with one small observation. When investors stop asking questions, that's when risk explodes. And his latest 13F filing is a perfect reflection of that mindset. It's not random, it's not emotional, it's surgical. Because when he places a $1.1 billion short, it's a signal that something in the numbers just doesn't sit right. So, what exactly did Michael Burry just do? To understand it, we've got to look at his latest 13F filing, that quarterly report every major investor sends to the SEC, showing what they owned at the end of the quarter. Think of it like a public X-ray of their portfolio. Burry's newest one was filed in early November 2025, covering his holdings as of September 30th. The total reported value, $1.38 billion. And here's the part that made headlines. Almost 80% of that entire portfolio is tied to just two trades. Both are put options, meaning he profits if the stock price falls. The first is on Palantir, worth around $912 million. The second is on NVIDIA, worth about $186 million. That doesn't mean he spent $1.1 billion in cash. The 13F shows the notional value of the underlying shares, not what he actually paid for the options. But the scale of these bets tells you everything about his conviction. While most investors are pouring money into AI stocks like their lottery tickets, Burry is essentially standing on the other side of the trade, saying, this has gone too far. Let's break that down. NVIDIA isn't just a chip company anymore. It's become the face of the AI revolution. Its stock exploded as data centers, startups, and every major tech player raced to grab GPUs. By mid to late 2025, it has become a cultural moment. Analysts called NVIDIA the most important company on Earth. Its valuation soared beyond reason, pricing and flawless growth for years to come. Burry looked at that and saw something else. Perfection. And perfection never lasts. His puts on NVIDIA aren't necessarily a bet that the company will collapse, but that the expectations will. If revenue growth slows even slightly, or if AI spending cools off, a company trading at sky-high multiples can tumble fast. In other words, he's not shorting NVIDIA the business, he's shorting the euphoria around it. Then there's Palantir, a name that fires up emotions on both sides. It's the data intelligence company that sells AI-powered software to governments and corporations. And in 2025, its stock became a retail investor favorite, dubbed as the next trillion-dollar company. But when you dig into the numbers, its growth looked modest compared to the hype. Revenues were rising, yes, but profits were thin, margins inconsistent, and valuations stretched to extremes. Burry's put position on Palantir, nearly $912 million in notional value, is a statement. It says, great story, wrong price. He's seen this before, when sentiment and storytelling outpace fundamentals. In .com, in the housing bubble, and in crypto. Here's a simple way to think about it. Imagine everyone buying lottery tickets because one person won big last week. That's what happens in hype cycles. People mistake momentum for safety. Burry looks at those moments and says, great story, bad math. And that's why these two names, Nvidia and Palantir, sit right at the center of his portfolio. They represent the same idea in different forms. A market chasing dreams faster than reality can catch up. But the real twist is that while he's betting against these flashy tech names, he's buying into something else, sectors that most investors aren't even looking at: energy, healthcare, real-world cash flow. Let's unpack that next. Now here's where things get really interesting. For someone who just placed a billion-dollar bet against the AI boom, Burry's long positions tell a very different story. He's not sitting entirely on the sidelines. He's selectively leaning into areas of the market that still make mathematical sense. First up, Pfizer. Yep, the same pharmaceutical giant behind the COVID vaccine. Burry holds call options. That's a bet that the stock price rises. The filing shows around 6 million underlying shares tied to those calls, worth roughly $152 million. After years of weak performance and fading pandemic profits, Pfizer's stock looked cheap compared to its historical averages. It's the kind of setup Burry loves, a solid company, unloved by investors, sitting on real cash flow while everyone chases hype elsewhere. Then there's Halliburton, a major player in the energy services sector. Burry holds calls there too, worth about $61.5 million. That tells us he's bullish on traditional energy, oil, drilling, service companies, the nuts and bolts that keep the economy running when inflation stays sticky or demand rebounds. But he doesn't stop at options. The filing also lists several common stock holdings: Molina Healthcare, a managed care company tied to real healthcare spending; SLM Corporation, which profits from student lending; Lululemon, a steady consumer brand; and Bruker's 6.375% mandatory convertible, preferred open parenthesis BRKRP close parenthesis, a hybrid investment that pays income now and converts to stock later. Add it all up and you start to see a pattern. Burry's not short the world, he's just short the narrative. He's betting against inflated tech optimism while quietly owning pieces of the economy that still generate real earnings, real demand, and real cash flow. The hype cycle will cool off, but life keeps going. People still need medicine, energy, and clothes. And that's where his strategy gets fascinating. It's not just bearish, it's barbelled. Let's break down what that means and how it fits into his bigger view of the market. When you zoom out on Burry's portfolio, it's not chaos, it's balance. It's what investors call a barbell strategy. On one side, he's heavily shorting the most overvalued parts of the market, companies like Nvidia and Palantir that have become symbols of the AI mania. On the other hand, he's going long on old-school cash-generating sectors like healthcare and energy. A barbell strategy works like this. You keep exposure to two extremes that behave differently depending on what the market does next. If the bubble pops, your defensive side holds or gains. If the bubble keeps inflating, your hedge cushions the pain. Either way, you survive and possibly thrive when everyone else is overexposed to one story. That's Burry's signature move. He's not trying to time the exact day the market cracks. He's preparing for when it inevitably does. Look back at his activity across 2025. In Q1, he bet against overhyped AI and Chinese tech names. In Q2, he swung to bullish positions in healthcare and consumer stocks. And by Q3, he circled back, doubling down on the AI short, but keeping those value-oriented longs. He's following where the risk is moving. And there's a deeper message here. Burry isn't anti-AI. He's anti-excess. He's seen how bubbles form. It starts when people stop asking, what's this worth? And start saying, it'll go up forever. The housing market did that. Crypto did that. Now, parts of AI might be doing the same. So, while the crowd piles into the trend, Burry positioned himself where numbers make sense, and hype has a limit. And that perspective brings us to the real question. What does he see in the bigger picture? What's happening in the economy that makes him think it's time to hedge this hard? So, what's he seeing out there that's got him hedging this hard? If you zoom out beyond the stock tickers, the bigger picture starts to make sense. The market in 2025 has been running on a strange mix of hope and denial. Inflation hasn't completely disappeared. Interest rates are still higher than most investors remember, and yet stock prices act like we're in the early stages of a new golden age. That kind of optimism is exactly what makes Burry nervous. When borrowing costs stay high, corporate profits usually tighten, spending slows, and risk appetite fades. But right now, valuations in the AI sector are pricing in flawless execution, endless demand, zero competition, and no margin pressure. History shows that kind of perfection never lasts long. And it's not just about tech. Consumer debt is at record highs. Credit card delinquencies are creeping up. Student loan payments have resumed. Housing affordability is the worst it's been in decades. Yet, somehow, markets keep making new highs. That disconnect between the economy and the stock market is exactly where bubbles love to hide. So, when Burry buys Pfizer and Halliburton, he's not just picking random names. He's hedging against a reality check. Pharma and energy tend to hold up when growth slows, or when inflation refuses to die down. They're like financial seatbelts, not exciting, but priceless when the road gets bumpy. And his Palantir and Nvidia puts? Those are the warning flares. They're how he expresses the view that the market has gone numb to risk, that prices have stopped reflecting uncertainty. And when you look at the history of bubbles, that's usually the moment the clock starts ticking. Before you go ahead and copy Burry, it's worth remembering what these filings actually show and what they don't. A 13F is just a snapshot of what he owned on the last day of the quarter, not what he owns today. He could have added, cut, or closed those trades a week later. That $1.1 billion figure isn't cash on the line either. It's the notional value of the stocks tied to his options. The real cost could be a fraction of that. It's leverage, not a full cash bet. And because the filing hides strike prices, expirations, and hedges, we can't know his exact exposure. So when people say Burry shorted $1.3 billion of AI, they're only half right. The truth is more nuanced, and understanding that nuance is what separates hype from insight. So what can we actually take away from Michael Burry's $1.1 billion short? It's not about copying his trades or betting against the market. It's about learning how to think like him. He looks at a world that's convinced it can't lose and asks, what if it can? That single question is what separates luck from strategy. Bubbles aren't built on lies. They're built on beliefs that go unquestioned. AI might change the world, but that doesn't mean every AI stock deserves infinite growth. And when optimism turns into certainty, risk hides in plain sight. So the lesson isn't fear, it's awareness. Understand what you're investing in. Know the story you're buying. And if the story stops making sense, don't be afraid to step aside. Because whether you agree with Burry or not, his moves force us to look closer at the market, at ourselves, and at what we're really betting on. Want to know Burry's 4 patterns that always show up before every major crash in the last 500 years? And how they're appearing again right now? Click the video on screen to see for yourself.